Economists are celebrating the April and May surge in consumer borrowing. And though the pace has slowed down a bit, it continues to climb. Here to tell us more about the benefits and possible drawbacks of the surge is Sandag's chief economist, Marnie Cox. Welcome back.
Thank you, Peggy.
Now, Marnie, what does this increase in consumer borrowing actually mean for national and San Diego economies?
Well, most economists read it as an indicator that people are feeling more comfortable to borrow as opposed to paying out of their earnings in order to consume, which is a good sign. Usually that means that they expect their job to last, they expect their earnings to go up, and they're comfortable with their outstanding debt. There are some concerns that are still out there today.
And we will definitely get to those. Do you think it's that it's been so long and things are slightly rising in fueling this kind of confidence that you were talking about?
Well, I think the rising confidence is associated with declining unemployment rate, the high number of jobs that are being generated per month. Those kinds of things are all good indicators of confidence.
Let's talk about personal credit. During the recession, lenders really tightened up their belts and it was hard to get credit. Has that changed?
Not so much. It's starting to change a little bit today, but it's still hard. Your credit score, if you're going to buy a car or you're going to buy a house or something, you still have to have a good credit score. And a lot of people are not qualifying for the prime interest rates or lowest down payments if you don't have a good credit score. So it's still very having a significant impact on people who would like to borrow and take out credit.
And they're not qualifying because of the recession and maybe losing their homes or having bad credit for whatever happened during the recession?
Yeah, a number of the people who either weren't able to pay their revolving credit, or secondly, as you pointed out, they may have mortgage loans they weren't able to make. Maybe they've lost their house. All of those people have low credit scores today.
I know auto manufacturing and housing markets were really hard hit by the recession. What's the borrowing situation in those two industries?
In which of the industries?
Auto manufacturing and housing.
Actually, auto is hitting new highs. About 17 million units were sold this previous year. That's a new high. Went down during the recession to about 14 million, so a lot of people are out buying new cars. That's because the average age is about 10 years, so they've got to have replacement, and interest rates are low. You've seen some of the banks offering 2% or less, sometimes zero for 60 months from car dealers.
And let's talk about the housing. And I know San Diego Association of Realtors said that home sales have been climbing. So how is that impacting this sort of consumer confidence?
We have a little ways more to go on the sales side or purchases of new homes. They have begun to increase, and prices have increased faster than the sales, for example. And that's because there's limited inventory that's out there. But I think that what we'll see in the future, if there's continued limited inventory, and right now a good example of that was the number of permits that have been authorized. They've increased to about 8,200 this previous year off of a base of about, in 2010, of about 3,000. So they have gone up, but we're expecting them to get to 12 to 13,000 before they ever get back up to the place where we think they would be normal. So they have more to go. That means there's limited inventory. Prices will probably continue to rise, but probably not at the pace that they've been going over the last couple of years.
Let's talk a little bit about credit card spending, getting back to the borrowing, now the spending. Has that gone up? Are people buying more?
Yes, they are. And in fact, part of the reason for this debt going up is they're spending not only what their earnings are, but they're spending more than what they're earning. So there's long-term debt being taken out in order for people to consume more.
And that leads me to this last question here. Wages in San Diego are still stagnant. The cost of living here continues to climb. What are the dangers in increased consumer borrowing?
Yeah, this debt side says they may be feeling a little more comfortable, but the sort of wave or the red flags are the quality of job growth and wage increases. Quality of job growth has been relatively poor. About 40% of it has been part-time jobs. And then wages have gone up less than 2% per year, so the last 4 years in a row.
Is there, if you had to say one takeaway message for consumers, maybe your confidence is up, but when it comes to borrowing, is there a formula that you would guide somebody with?
Yeah, don't take out more in terms of debt than what you can pay back based upon your earnings growth. Don't go into equity. Don't go into your savings account and assume that that's going to continue to grow over time. Stay within your earnings potential.
So use your earnings to buy consumer goods and then credit for other things. All right, economist Marnie Cox, thank you very much.
Thank you, Peggy.